Thanks for joining me. I'm Kate Edwards from Together Hospitality. I'm joined by my friend Neha. Hi.
Hi, I'm Neha Govindraj. I'm the founder of Bonside, where we do financing for brick and mortar businesses.
Now, you developed your business because you've been an operator with a brick and mortar business. How did that lead into Bonside?
Prior to Bonside, started my career at Bain & Company, where I worked in private equity in the retail practice. And coming out of that, I started a brick and mortar business here in New York called Glow Bar, where we do 30-minute facials. And in building that business is where I realized that there was an opportunity to better serve multi-unit operators with capital solutions that were tailored to them. It seems like a lot of options that are on the market for capital have been in some ways retrofitted for brick and mortar. It was never really designed for brick and mortar.
Okay.
We think about equity options, we think about debt options, but they weren't designed with brick and mortar operators in mind.
Interesting.
And we see that playing out now, and that was really the impetus to say, hey, there's a need for something to be more tailored to the brick and mortar industry. For the longest time, especially at its peak, venture capital was really kind of the gold standard for how a business scales. The first instance of a venture capital deal was not for a brick and mortar business. It was for a tech business, and it made sense for a tech business because the trade was, I'm going to make a really risky bet at every stage of your company. And the hope is that I, in exchange for that, can own a percentage of the company and be a part of some outsized, unpredictable, uncapped return. And you've seen that play out in tech businesses.
Right.
But for brick and mortar businesses, it's a little bit different. Once you have a handful of locations, it's not that risky. And someone's putting capital in. If your only goal is to open more locations, so you're not launching product lines, you're not building technology, you kind of know what sort of return that capital is going to unlock because we have capacity constraints. It's a different business model that requires an asset class that acknowledges that and can provide capital against that.
But if you're, let's say, somebody who's just starting out, how do you sort of navigate these options for yourself?
If you're just starting out, there's a couple of common options that come to mind for folks. Okay, I can access equity-like capital, which is dilutive capital, in that you are giving up a percentage of your business in exchange for that capital.
Right, just like Shark Tank.
Just like Shark, just certain judges on Shark Tank.
Right, exactly.
And so maybe you bring on angel investors, or you bring on venture capital, or you bring on private equity, and each of those are appropriate at different stages of growth. But we've also met founders who say, from day zero, I want to bootstrap this business, which means I don't want to take outside capital. I want 100% ownership of my creation. So maybe they start to look at more debt-like options, where you're tied to paying back the capital in a certain period of time versus giving up a percentage of ownership in your business. So what capital you take when is a matter of stage of business, how risky is your investment at that point in time, but then also personal preference. What kind of business do you want to build? What kind of business do you want to scale? And which option makes the most sense for that? Simply put, capital comes with expectations. Let's say you have 4 locations in place and you're deciding where to take on that additional tranche of capital from. If you end up taking it on from a private equity investor, that capital has expectations and they're not hiding it. They have returns that they need to meet. They have their business that they're running.
Right.
And so as soon as you take those dollars, you are signing up for a growth trajectory, whether you explicitly write it out or not.
Yeah.
They're expecting a certain level of return and a level of high growth. And not every business owner wants to do that and supercharge their business in that way. And that's where maybe not even they don't want to do that, but maybe no one has their mind made up yet. Maybe you do want to do that, but it's too early for you to decide to do that.
Right.
And that's really where we thought, okay, there's an opportunity to launch another capital option here that doesn't eliminate that option, but if anything, it pushes it off a little bit. And you can say, okay, I'm going to take on Bonside capital and I'm going to open my next 2 locations. And then after that, maybe I'll have a better idea of, do I want to take on private equity? Do I want to grow my business in that way? It's important to know ahead of taking the capital what you want to do with your business. If you want to open 1 location a year, don't go raise private equity.
Right.
That's probably not the best option for you. It's really dependent on the business owner. And for what it's worth, I do think you can do both. Like at Bonside, we've personally worked with businesses that have 40 locations, but also businesses that have 5 locations.
Right.
It's just ensuring, and I think that was the impetus for starting our business, was I wanted to create a capital option that didn't close doors for people, that actually just kept them open and said, okay, if I have 40 locations, I can take on capital from here and it doesn't send any kind of signal to the market. If I have 4 locations, I can take capital from here without sending any signals to the market.
Right.
And so that's really where this idea of there needs to be something tailored and really designed, purpose-made, purpose-built for brick and mortar came into play.
And then you mentioned, these very large-scale companies that you work with versus somebody who's got maybe 1, 2, 3 locations. Is there anything that is through line between them? Is there anything that that is the same for these types of businesses?
Yeah, so we are really focused on the services industry. We work with food and beverage, wellness, traditional services like a car wash or a daycare. And the entire thesis behind this is these are all businesses that maybe have different end markets, different products, but have very similar business models in that they all have rent, they all have labor that is affiliated with delivering a service, so it's a specialized labor force. They all have utilities and maintenance and COGS, and really focused on hospitality and delivering an experience. They're experience-based. And so that informs a lot about how we underwrite businesses because
Right.
there's actually a lot of commonality. And so when a business comes to work with Bonside, one, they are a services-based business, but two, they are thinking about growth. So the biggest thing that each of these businesses have in common is that they are signing a lease, they are about to sign a lease, they signed a lease, they're thinking about that next location. And for us, all we look at is what have you historically done and what's the next step that you're putting forward, which is very different from a lot of other underwriters that are either saying, like a debt underwriter would say, what have you historically done, both at your business and you personally, what are your
Right.
personal assets?
Right.
And then an equity investor is, what have you historically done? But also, what does the next 5 years look like, the next 7 years look like, the addressable market? It's a lot of questions
Right.
that you should have a strong perspective on. Hey, what have you done historically? Let your data speak for itself, and then show me that you're doing something next.
And then when you think about, let's say, that first timer who's maybe hearing this and they're like, I'm going to open that first thing.
Right.
What is something that is helpful for them to start to think about in terms of potential financing in the future?
The first location is an interesting one just because at that point, it really is a true equity risk in
Right.
that you don't have a playbook, you don't have a track record, you don't have historical data
Right.
to show that you've done it before. Typically, folks are leveraging angel investors or SBA capital, which requires personal guarantees,
Right.
or they've saved up and they're using personal capital.
Right.
It is a different level of risk when you're opening that first store. It is the same level of risk as starting any company.
That's right.
In that it's just unproven. And
Yeah.
so with starting your first location, that's where you need to be extremely thoughtful around that capital source of, do you want to bring on a financial partner? Do you want to bootstrap it yourself with your own capital? Or do you want to go take on debt and have your personal assets tied to that?
And then do you have like a success story of somebody growing and using you guys as a partner for this growth?
Yeah, definitely. I mean, that's everyone in our portfolio. I think the beauty of it is people come to us to take on capital to help build out their next location. And so every business in our portfolio has opened a new door since taking on capital from us. And there's certain businesses that have doubled their footprint and have taken capital on from us twice. And that's the entire goal, which is how can we be in lockstep with you? How can we get you capital when you need it for the next thing and the next thing? Because the beauty of brick and mortar is once you have locations that are open and running and profitable EBITDA, those are stable locations.
Right.
So no matter what's to come, you have the stability of these existing locations.
That's right.
And so I always describe it as like this step graph where it's like, okay, open a new location, new band of revenue unlocked. Open a new location, new band of revenue unlocked.
Right.
Which is very different from a software company where
That's
it's
right.
this like kind of curve and the
That's
exponential
right.
growth. So our goal is to be there at every step. So we enter at one step and then we watch the businesses climb to the next steps.
Right. I love that visual. That makes a lot
Yeah.
of sense.
Yeah.
Yes. Thanks for sharing with us today.
Of course, yeah.
I appreciate it.
Thanks for having me. Thanks for asking me.
You're welcome.